Welcome to the Josh and Erik Show. I'm Erik.
And I'm Josh. Today, we're going to talk about, with Stephen here, what it takes to get a business loan.
That's exactly right. Well, hey, first off, Erik, Josh, thanks for having me on. And this is a great setup. Excited to be here. Let me just first say that banking can be somewhat extremely confusing, but I'm here to at least try and make some of these things simpler. So, name's Stephen Elias, been a commercial banker for about 10 years here in the great state of Oklahoma, and been on the commercial side my whole life. I'm happy to share at least some of the insights, and I will say I won't give out any trade secrets necessarily that are going to be specific to the bank that I work with or give any insider information, but absolutely these are tips that I think anyone looking to start a business or grow theirs needs to know.
What would be some things if I'm walking in as a young entrepreneur, old entrepreneur, age is irrelevant? What would be the first thing I walk in the door? How would I pick a bank?
Well, if it looks like you, I'd just give you the loan immediately. Like with a beard and mustache like that, I don't even think I'd ask a question. You'd have money in your pocket before you entered the door. No, but in reality, there's a couple of key things that a bank, no matter what bank you go to, by and large, these are the things they're going to look for. And everyone remember this, because I think this is, if you're going to take anything out of the show, these are the 5 things to remember. You're going to hear this. The 5 C's of credit: capacity, capital, conditions, character, and collateral. Those 5 things are the only thing that you should keep at the front of your mind when you're thinking about your business and are you prepared for a loan. First one's capacity. It's a fancy name for how much money do you make? How much money does your business make in order for me as a banker to say, oh, you make a lot of money. You can afford a large loan because I'm not worried about you paying it back. Versus if you have a business that has a lot of revenue, but again, when we say make a lot of money, we're talking net income or EBITDA. If you hear a banker ever say that, that's earnings before interest, taxes, depreciation, amortization. It's basically cash flow. If you don't make a lot of that, well, guess what? You can't afford an extremely high loan because you're going to need to pay interest and all the principal back within a certain amount of time. So the second one is capital, or better yet, everyone knows this is cash. You're gonna hear this, cash is king. The hardest part about getting a loan sometimes is just the simple fact that you need some cash on hand. If you are a newer company, meaning you just started your business maybe in the past 2 or 3 years, or if you don't even have a business and you're starting one, you are probably not making any money yet, or you're even pre-revenue, so you haven't even opened your doors, but you have a concept. A lot of times businesses don't start up with a loan. They'll usually start up with 2, 3, 4 people getting together and saying, hey, we believe in this business. We're gonna pool our money together, and that'll give us enough capital for a year of operations. And that'll do 2 main things. One, it gets you off the ground, and it's the easiest way to get your business started when you guys are your biggest advocates. And then 2, it lets you have what we're gonna touch base on here is a track record, because that's another big thing that bankers will look at is, what's your credit history? If you guys walk in with a business plan and nothing else to your name, no personal credit history, no business credit history, it's somewhat of a shot in a prayer, and we better have a great relationship. Otherwise, you're a flip of a coin whether that's a good deal, and that's being generous.
Don't get overwhelmed when you're trying to start your business. There's a lot of resources out there that you can utilize. For me, I went to the SBA. They had a local office. They helped me locate a banker. They helped me write a business plan. I got my first loan with that $5,000. It's all I had, right? I've said that many times on this show.
So there's 3 more C's, and I'll go through these ones pretty quickly because I think the first 2 are the most important.
Gotcha.
The third one is character. How relatable are you as a business owner? What's your business acumen? Have you come prepared? And do I feel like you'd be flexible down the road? Because I'll give you some horror stories another time, but let me tell you, business is not always going to be smooth. Any banker can loan when business is rocking and rolling. When stuff hits the fan, that's when we need to be coming back down to the table and say, hey, we need to work through this. What's the best way to do it? And if I feel like that borrower across from me doesn't have good character, well, guess what? It's going to be tougher to make that loan than someone who is really putting their neck out, putting their skin in the game and saying, yeah, I'm going to work through this with you guys.
So what's the next C?
Conditions. This one's somewhat boring, but it's important. This means, what are you buying? Specifically, like, why are you buying it? I'll give you an example. If you're on call and you guys need to buy a septic truck out there, me as a banker is not going to even think twice. I know what you're going to use it for. If you're an auto body shop and you want to buy a corporate jet, I'm going to scratch my head and slow down a little bit. And then to round it out, the last C is collateral.
And collateral basically is, and correct me if I'm wrong, is something that you own that has a worth that you're willing to put up.
Yep.
Collateral, yeah, exactly. So collateral
Exactly
can be cars, it could be your house, anything that has value that's worth more than you owe.
Exactly right. And the thing that you're buying with the loan will be considered in that collateral.
And banks, from my experience, Stephen, and tell us if I'm wrong, banks tend to like to loan to physical assets and not goodwill or hot air, meaning a truck, a container, things, I'm just giving an example of things that we're in, right? A piece of real estate, things that they can feel, see, and touch versus
intellectual property,
IP,
you want to buy a trademark,
domain names, things that they cannot go repo. So what happens if they don't have a lot of cash? They go in there, they apply for a loan. In this case, we're referring to a small business and or startup. They don't have a lot of cash, they're not established. Do you take in consideration if somebody's willing to co-sign, like a car, or somebody's willing to throw up and put up that collateral on behalf of them?
On the smaller businesses that probably don't have a lot of cash, before you even start talking to a banker, you need to think of one thing. How much equity do I have today? Equity is the start of all businesses.
What is equity?
Equity, yeah, it's a great question. It is the asset side minus the liability side of a business, in which for those of you who are scratching your heads on what's the asset, what's the liability, Google. It'll be your best friend. We won't get into it here, but you can quickly figure out in general accounting terms, what's an asset for your business, what's a liability, and those two, assets minus liabilities, that's your equity.
So to put it in redneck terms, folks, it's what you owe and what it's worth in the gap.
Yep.
That is your equity or net worth.
Well put.
So let's say I started a new business. I've generated a little bit of funds. I've got my P&L, my balance sheet, a little bit that it is. And I come to you. What documentation are you looking for to start business with the bank?
Yep.
To get money from the bank? What documentation can I give you as a brand new business entrepreneur, right? What documentation can I give you to get a loan started?
It's probably the biggest pitfall you'll see with companies is that they're so focused on growing their business that they're not really considering that exact question and answer on what do you need to show. So you need to show a couple of key things, and I'll keep these more brief because if you were to do anything when you walk into a bank, have these ready to go. It'll show well. One, financials. You just mentioned it. A P&L and a balance sheet. The more years, the better. Profit and loss statement. For
P&L, folks, is profit loss. Balance sheet is everything you own.
Exactly right.
So P&L, cash in, cash out. Balance sheet, assets.
Yep.
Trucks, computers. What do you own? Let's simplify this.
What else do you need documentation wise, or is there anything else to get started with you?
Personal financial statement and your personal tax returns, because you, the owners, are going to be your best line of defense. You're your best advocates at the end of the day. For as much as I'd say that the bank can be the knight in shining armor, we still have to make sure that the regulators, which are looking over our shoulders, know that we're doing safe loans and we know how to underwrite them. So again, personal financial statement and personal tax return. And then the last one that's often overlooked, projections. especially if you're a newer company. We need to know exactly what does your business look like in 3 years if you've only been operating for 1. So think about your revenues. How do you acquire customers? How much is it going to cost for those customers to be serviced?
So you're telling me that if you were me in my situation and I was a brand new entrepreneur coming to you, having a business plan, if you didn't have capital, but you had maybe some personal net worth, having a business plan and handing that in on the first time you meet is going to be pretty critical. That shows projections for customers, for revenue, for expenses is going to be a pretty critical document for you.
That's exactly the point.
Just because you write that business plan, you spend a lot of time focusing on it. Just because you put those projections in place, bankers know that those things are going to be adjusted as you run and operate your business. It never goes to plan. You have to be willing to navigate through the issues and change.
I think that's probably the best point, that most people have a misconception that the thing that they hand to the banker, it's like turning in your test and nothing can be changed. Guess what? Business is not an industry. All of businesses, they're evolving every second of every day. What you guys have built here looks a lot different than what it looked like 3 years ago, 4 years ago, right?
For sure.
So every entrepreneur or even small business needs to know that, hey, the relationship with your banker and how prepared you are today shows a lot, as you can potentially hit some speed bumps where you're going to have to be flexible, or you have to increase your projections because you're growing so fast. Now you need even more money that you weren't expecting. So that's a great point.
So let's talk about something, Stephen, the scariest thing of all, personally guaranteeing.
You said the PG word.
The PG.
And I'm about to make it rated R here. So let's get right down into it. So personal guarantee, and I want to clarify the biggest thing here on what it is and why you shouldn't necessarily be afraid of it, but still take it into consideration. So a personal guarantee, remember that personal financial statement that I mentioned to you guys earlier? It's got your assets and your liabilities. All this is saying is, hey, you can trust us as the borrower. We're not going to go and take out all the cash that we're making every single year and then buy tons of yachts and tons of exotic cars. We want to make sure that you know, which, mind you, if you make enough, you can do that. But it's basically aligning your guys' interests with the banks. Because what we don't want to have happen is the deal starts to go poorly. For whatever reason, a 2008 hits and you guys just bought 15 rental homes. Well,
or something more recently, a COVID.
Or COVID. And your business, that's business to consumer, is a great example, shuts down. Well, guess what? That personal guarantee basically gives comfort to the bank knowing that, hey, we know that you guys have skin in the game and you're going to work with us in order to do a repayment schedule, to extend out some terms and just be flexible. What I want to clarify here, and this is why it sometimes is a very sensitive subject, people often think that that personal guarantee, the bank, at any sign of trouble is going to say, I'm going to sell your house, I'm going to sell your cars, I'm going to kick you out on the street. Guess what? That is a last line of defense if all else was tried and did not work. But a bank makes no friends selling someone's home. Deal still worked.
So for you folks watching, let's break this down. A personal guarantee is an easy insurance policy that costs both parties, the bank and the consumer, a guarantee that you're going to be focused. You're going to try to pay them back.
Yeah.
They're lending you money. Pay them back. Mm-hmm. It's good business practices. It's a good insurance policy for the bank to know that you're going to pay attention.
And I would say, correct me if I'm wrong here, but it's almost, if you're coming in there as a new business owner, a new entrepreneur looking for some capital, it's pretty much a guarantee that you're going to have to sign a personal
That's exactly
guarantee.
Right. The Small Business Association, the SBA, requires a personal guarantee.
Yeah.
It is non-negotiable. If you want the great terms that the SBA does when it partners with a bank, you're signing a personal guarantee.
And I know my experience walking into a bank, they're usually super nice. Bankers usually dress to the T. and they have fancy office furniture, right? And they use big, fancy financial and accounting terms. But at the end of the day, a banker needs people like us to get loans for them to have all that fancy stuff, for them to lend that money. So don't be intimidated because they don't look like you, they don't talk like you. They lend us money, and we pay it back, and we PG it.
And you PG it. That's correct. That's exactly right.
I know that being in the real estate industry, taking out loans for equipment, taking out loans for business acquisitions, what does a typical term sheet look like? So for you out there, I did not do this. So I didn't know to do this, right? You can ask for a term sheet when applying for a loan. And that's can you explain what a term sheet is?
Absolutely. So a term sheet is basically just a summary of what you would expect to show up on official loan documents, but you're not signing anything typically on a term sheet. It just states who the borrower is, how much the loan or loans is going to be, your interest rate, and then some of the other reporting requirements on continuing financials that you'll need to provide to the bank, any other odds and ends. But before you get to down the road and you're just guessing what your loan documents might say, you're exactly right. Ask for a term sheet and then shop around just a little bit. Get a feel for what banks seem to be the most flexible. Get 2, maybe 3 term sheets, compare them, ask for another round of interviews if you have the time, and then you know you're getting the best deal.
You got your term sheet, right? You shopped your banks. You found the bank. You like the banker. Your personalities meet. After everything is approved, I have some equipment located in our case, or I have a piece of real estate located. How long is it going to take to get my funds?
Yeah, I'm going to give you somewhat of a terrible answer here, but this is the most accurate one from having worked at several banks, both extremely large and somewhat smaller. Mm-hmm. It depends on 2 things. One, how busy is the bank in general for that specific loan in that specific time? If you ask for a loan and you get approved 2 weeks before Christmas, that could easily take 4 weeks.
I think a lot of it, from my experience, is the type of loan and the amount of loan I am requesting. So every bank has different internal policies and procedures they have to go through. But if you're asking for $20,000 versus $10 million, there's going to be a different set of stipulations and timelines and documentation and committees that you have to get approved through. That takes time.
That's exactly right. And that's why the it depends is really the reason why I can't give you just a good range. Some banks will have the ability to sign off on millions and millions of dollars of loans with just a couple people. Other banks have what's called a committee process where they'll have this, as little as once a month, where their board gets together and their approvers and they decide on your loan. Well, guess what? If you missed committee by 1 day, you're waiting a month before they even look at the term sheet to give to you.
And take that into consideration, because one day, if you need money in a hurry and it takes a long time to get your initial funds, folks, don't be stupid.
Well, I think that's why this is such a good concept on a podcast and a show, is you guys are making sure that what we call financial literacy is spread amongst all those who need it, because it should not be reserved for the Fortune 500 companies and everyone else is just scraping over pennies. Yeah. I love seeing people know exactly what to expect when they walk into a banker's office. It does not have to be mine. We all benefit when you guys are doing great.
Yeah, and that is exactly the reason why we're doing this kind of podcast, is to help the audience in any way, shape, or form in the business realm. Give them the information, bring in the subject matter experts, put the people on the pedestal here, explain the do's and the don'ts, and if any of this concept, if any of this information can help you guys, that's what we're about. So,
yeah.
Now go get a loan.
Go get a loan.